Thank you for your interest in Caravel Concepts' CMPAS software. In this video, we will discuss what makes CMPAS different from our competitors. Financial planning software guides over $10 trillion in retail investor assets, yet there is no software in the market that combines financial planning and the investment strategy into a unified, easy-to-execute process. Until now. Meet CMPAS. CMPAS provides clients a believable plan, even in the worst market conditions, by unifying the investment and financial planning process. CMPAS is broken into two modules, CMPAS Allocation and CMPAS Planning. CMPAS Allocation is where the user creates, analyzes, and enhances their portfolio models. CMPAS Planning then takes those same portfolio models and creates unique, optimized portfolio strategies for each client's specific life goals. CMPAS has so much to offer, but let's focus on these 6 things that make us different and how those differences can help the financial professional. Static CMAs, or random walk theory, are the industry standard and what every other planning tool on the market runs in their simulation. CMPAS is the only software that provides price-driven or mean reversion capital market assumptions. With CMPAS Allocation, we give you the ability to compare static and price-driven CMAs for each asset class. As you can see, there's a substantial difference between the two. In this example, we see that the S&P 500 is overvalued compared to history, and therefore has a greater chance of lower returns than what we have seen historically. Dividend Aristocrat, however, is undervalued and therefore has a better chance of higher expected returns than we have seen historically. Our chairman and CEO, Michael Jones, has followed the mean reversion theory over his entire career as an asset manager. But at Caravel, we empower the manager to use whatever capital market assumptions they believe in. Most portfolio managers use the Morningstar style box when building their asset allocations. CMPAS Allocation contains underutilized asset classes provided by S&P Dow Jones indices that have outperformed in periods over the past 25 years, giving the portfolio manager an advantage over their competition. At the top, we show expected returns and volatility of the traditional large-cap styles. Let's look at some other options. S&P provides indices that filter the S&P 500 to meet a specific focus. What we have found is that in most of these, the expected returns are higher than the traditional choices and have less volatility. One exception would be in Style Focus, which can be used when a portfolio manager believes an increased volatility risk is worth a tactical play for a higher expected return. All of these underutilized indices can be implemented with a low-cost ETF. The last few years have been a potent reminder to investors that inflation will not remain static over time. CMPAS uses historical observations for the volatility and forward market projections to create a baseline median. This is included in the asset class simulations to incorporate the historical negative correlation between inflation and long-term returns. This negative correlation means that, as inflation rises, the dollar amount of client goals increase just as the real return available to fund those goals decrease for most asset classes. We think realistic long-term financial plans need to take into account this potential risk. CMPAS also allows the FA to magnify or dampen inflation impacts on a per-goal basis. For example, you can grow college costs at a rate higher than inflation. Therefore, CMPAS aids the advisor by creating more realistic plans. Portfolios either built or uploaded to CMPAS Allocation are directly integrated into CMPAS Planning. Each client receives a unique strategy for each of their goals and provides the advisor with the needed asset allocation down to an account level. Here's a quick animation to illustrate what we mean. First, this is how existing planning tools work. Here are your client's goals and their time horizons. Current tools will lump all of these goals together and pick a pre-canned asset allocation that they believe works best for their client. More often than not, that portfolio tends to be a 60-40. But what happens if, in the same year this client needs to pay tuition, the market takes a significant downturn? Then your client is stuck having to sell assets in a down market. This is bad for the client and bad for the client-advisor relationship. Now let's look at CMPAS with those same goals and time horizons. Instead of lumping all the goals together, each goal is treated as its own investment plan and allocated to the most appropriate portfolio model based on their time horizon and risk level. Their son will be going to college in 2030. That's 7 years from now, so put freshman and sophomore tuition into 60-40. Junior and senior tuition we will put into the 80-20, as it is 9 to 10 years from now. The sailboat is a 10-year goal, which we will put into the 80-20. Their retirement is 20 years away, so we'll put that into all equity. Many advisors already manually break the average solution into a more appropriate strategy for their clients, but this is a very time-consuming process. CMPAS automatically does this work for you and provides a dollar amount that should be moved into each portfolio model at the household level. CMPAS will automatically break each account into the appropriate asset allocations. Here we show all the accounts rolled up for you to see each portfolio at the household level. Each goal is treated as its own investment plan, matching each goal draw with the most appropriate portfolio model based on the portfolio's time horizon and risk level. Using the education example from before, we can see that the kid's college goal is being funded by the 529. All $70,000 in that account has been allocated to fund this goal. But we still need to fund another $21,000 to complete it. Therefore, that money has been pulled from the client's taxable account and has been put into the balance with growth and the growth portfolio. The $21,000 seen here is for the senior year tuition to finish funding. As goals move closer in time, CMPAS de-risks per goal through a glide path that notifies the advisor to move funds to more conservative portfolios. Let's see this illustrated. As the goal gets closer, the portfolios need to de-risk. By 2030, when the market falls, tuition for freshman and sophomore year are in cash. The junior and senior goals are now in 2080 portfolio and are about to de-risk to cash. This de-risking occurs in the simulation and in the actual software as you move through time. Here's what the 529 account will look like in 2030. This is a much better scenario because the goal draws are aligned with when the checks need to be written, and they are not exposed to market movements. Once you have created a plan, it is put on autopilot and runs monthly. When certain conditions arise in the plan, advisors will be notified in order to make adjustments. For example, if a deficit appears in the plan run. The advisor will also be notified when it's time to review a client's plan and when it's time to de-risk. We hope you've enjoyed learning about Caravel Concepts software solutions. If you have any questions or would like to see a demonstration, please reach out to us via email or through our website. Thank you.